Hi everybody, Howard Friend here. Welcome to the second in a series of webinars I'm doing for CFI on a range of technical analysis and market related themes. So this one, as you know, is all about technical analysis and in particular about trend following tools. So I'll be talking about things like moving averages, Bollinger Bands, Untitled channels, and some of the tools that market technicians and traders use to identify the trend and to give them a directional bias before making trades. So before I continue, just a quick question: can everybody hear me? Please answer yes in the text. Okay, great. Okay, so let's move on. So, as I say, we're going to be talking about trend following indicators, moving averages. I'll spend a little bit of time on moving averages. There are lots of different types of moving average, and I'll be showing you some of the ways that swing traders and trend traders like to use them. Okay, so first thing being first, so basically, the reason technicians, traders like to use moving averages is because price movements are quite volatile. So the idea to use the moving average is to filter out a lot of the random noise to get more of a kind of a gauge as to which way the market is trying to go. When a market trends, you'll tend to find a lot of jerky movements up and down, but the direction is kind of, sometimes it can be a little bit difficult to ascertain. But with the help of a moving average or a combination of moving averages, we can clearly define which way the market is going. So moving averages are used to reduce the noise to a minimum and to simplify the analysis of the price chart. So moving averages are there to identify the trend and also to provide some levels of support and resistance for you to use to enter into the trend. So moving averages, they're lagging in terms of, they're not forward looking, they're not predictive. They're actually, they're lagging the price action. So they tell you where the market has been. So for some people, that's a bit of a problem because we want to know where the market's going to go in the future. But for others who believe that the trends tend to persist longer than most people can stay in the market, it's good to use the moving averages as a gauge for the direction. So the market will tend to be in a trend until it shows really clear signs that the trend is reversing. So as I say, it's based on historical data. It's not predictive, but that has many positive features as well. So for moving averages to be of use to us, the market obviously has to be in a trend. So the market has to actually be moving in a certain direction rather than just up and down, sideways, for moving averages to have value. So in other words, if a market is trending higher and it makes a big move to the upside, we're looking for the pullback to come back into a moving average zone. So the moving averages can offer value to patient traders who want to get into the trend after a pullback. So a thing about the moving averages is obviously you can have moving averages ranging from one period out to several hundred period. So you hear people talk about the 200-day moving average and the 20-day moving average and the 7-week moving average and maybe Fibonacci numbers of moving averages. The point being that, as with most technical indicators, the shorter the length of the indicator, the more volatile it's going to be. And the more signals you are going to get. So it can be good, obviously, if the trend is actually sort of moving very fast and it gets you into a new trend very early. But if the trend moves kind of slow and doesn't immediately go in its direction straight away, you can get several whipsaws as the market action goes from side to side before the market actually develops its trend. So the shorter moving averages, they can be quicker to get you into a trend, but if the breakout is actually a full signal, then the moving average will get you in a little bit ahead of time. So the shorter moving averages are more sensitive, the longer term moving averages are less sensitive. And I think a combination of the two is actually quite good for you to ascertain whether the market is actually in trend mode or not. So there are three main types of moving averages. There is a simple moving average, the weighted moving average, and an exponential moving average. Now, they all try to do the same kind of thing, but the weighted and the exponential moving averages, they place a greater weighting on more recent data with a view to getting earlier signals than one would normally get with a simple moving average. Okay. So this is essentially how the moving average interacts with the price. So in an uptrend, you'll have the price kind of zigzagging higher, like so, and the moving average lagging behind it. So as the price moves higher, the latest value of the moving average is added, and the last value of the moving average is removed. So if it's a 10-day moving average, for example, the most recent day is added to the calculation, and the last day, the 11 days ago actually, is taken off the calculation, and then the average is drawn again at the new level. In a downtrend, the market starts off, it chops down like this, and the moving average just lags down like so. So in a downtrend, the moving average, it's a bit like a curvy kind of trend line, if you will. The market kind of goes down and it finds resistance at the moving average very often, and it's a good place to look to enter trades in the direction of the trend. Okay, so the simple moving average is basically we're adding up the closing values for the number of for the period that we're looking at, and we're dividing it by the number of observations. So as an example, 5-day moving average, a 5-day simple moving average adds up the values of the last five-day closing prices, although a moving average can be applied to other values such as the high and the low and the typical price and many other things. But more often than not, the moving average, the simple moving average, is done by adding up the value of the last n bars that we're looking at. So in this case, we add the closing values for the last 5 days and we divide that number by 5. And that will give you the present value of the 5-day simple moving average. So as I say, when a new value is included, the first value drops off and so on and so forth. So as I mentioned before, the moving average is actually based on historical data and it lags the price. It's not predictive. So don't be looking at moving averages to give you a prediction into the future of the price. The weighted moving average, as I mentioned before, gives a bit more weighting to more recent data. So there's a factor that is applied to more recent data. So what you'll get is when the simple moving average turns, the weighted moving average will turn a little bit earlier because the more recent data is given a higher weighting in the calculation. So the idea being that if we're using moving averages to tell us when the trend has changed, then we want to be alerted to that trend change as soon as possible. So using a weighted moving average will give us an earlier signal alert that the trend has most likely changed. So a change in direction rather than the crossover is actually where the value lies for this kind of indicator using the weighted average. So if you're looking at one moving average against another moving average, simple versus weighted, you'll see the weighted moving average change direction before the simple moving average. The exponential moving average is, it uses the simple moving average and also it applies a multiplier for the weighting. So it's another weighted kind of moving average. But all three moving averages are there really to essentially do the same thing, to give you a handle on the trend and to let you know when the trend has changed as soon as possible. Okay, so just to show how the simple exponentially weighted and weighted moving averages are, they interplay with each other. This is a chart of the price, the single line here, and the red is the weighted, the pink is the simple moving average, and the blue is the exponential moving average. So you can see the price turns first, obviously, and the moving averages, they follow the price down. So as the price is trending lower, the more recent values are added and the previous values are dropped off. But because the weighted and the exponential are they apply more weighting to more recent data, they will turn quicker than the simple moving averages they do here. So what you can see here is the price compared to the three different types of 10-day moving average and how they look compared to each other. Okay, so how do we use the moving averages to determine what the trend is? So the most simple way is to compare the closing price of the security that we're looking at, the currency, the stock, whatever, and compare it to its N-bar moving average. So a close above the moving average is said to be bullish, a close below the moving average is said to be bearish, the trend is up or the trend is down. So a very simple way to determine the trend. Some may say too simple because there are many whipsaws, and we can come to that a little bit later on, how to identify, how to filter out whipsaws. But this is just a simple way. You'll often hear people talking about where is the close in relation to, say, the 200-day moving average for stock prices or for stock indices and so on and so forth. So we're simply comparing the price of the market to its N-bar moving average. So that's a simple way to do it. The next way that technicians like to do it is to look at shorter term, to compare two moving averages, to compare a shorter term moving average to a longer term moving average, and look for the crossover between the two moving averages. So if the shorter term moving average is above the longer term moving average, the trend is said to be up. And if the shorter term moving average is below the longer term moving average, the trend is said to be down. So you'll often hear terminology like golden cross and dead cross, that kind of thing. It just refers to whether the short-term moving average is above or below the longer-term moving average, and that gives you your trend signal. So this method is actually a bit less sensitive than the price versus the moving average, which will give you a lot more signals. It's a lot quicker, simply because we are using less and less data points, because we're using longer term derivatives of the price chart. Another way to use moving averages is to look at the slope of the moving average to determine the trend. So if the moving average is sloped higher, in other words, we're getting progressively higher and higher moving average values, then the trend is said to be up. Now this trend direction, in other words, which way the moving average is going, can often give you an earlier signal than some of the more traditional methods. So some people like to look at if the moving average is trending higher or trending lower, that can give people the indication that the trend is up or down. So what about these whipsaws? Well, obviously no indicator is foolproof and gets it right every time. And many times that's the function of a feature of markets, that markets like to do these kind of fake out moves, these kind of false breakouts, which can trick people into believing that the market is going one way or the other, and then you get the real move in the opposite direction. So there are many methods that technicians use to filter out bad or false signals which the moving averages give you. As an example, you might require two closing prices above or below the moving average. If we're looking at price fee moving average, that could give you a bit of a filter there. So waiting not for one close, but maybe for two closes, that could give you that could filter out some of the bad signals that you might get with a moving average situation. You could also look for a minimum distance above or below the moving average. So let's say for supposition, you're looking at a stock index and you might want the stock index to close above a moving average, but above a moving average by, say, 1%. So that's another way to help filter out some of the whipsaws that you get with moving averages. Another way to do this, and we'll come to this a bit later, is to use price envelopes. In other words, not just to use the moving average of the closing price, but to use the moving average of the closing price plus or minus a certain amount, or to use a moving average of the high price rather than the close price and the low price rather than the close price, And these two ways actually create a band, a neutral band, if you will, where if the market is between the upper and the lower band of the bands that you've created, then we're kind of in a neutral mode. So in other words, we're not constantly long or short or directional bias, positive or negative. So this way we can actually filter out some of the false signals that we would get with moving averages. Another way to do it would be to use what they call a displaced moving average, and that's moving an average of the closing price backwards or forwards on the chart. I'm not a big fan of that myself, but some people like to do that. Okay, so let's just take a look at how the moving average works in terms of the shorter and the longer term moving average together. So this chart here just shows you the interplay with a shorter moving average, in this case in blue, and a longer term moving average, in this case in red. So when the market is trending higher, you'll get a crossover, usually well after the turning point, but that's not always a problem, because if the market corrects back, then you've got yourself the trend indicator that tells you that the trend is up. So you've got yourself a situation here where the blue has crossed above the red, and the market is going higher, and the averages are going higher, and they should, to a certain degree, offer support in an uptrend situation. In a downtrend situation, the shorter moving average, again in blue, crosses below the longer moving average, again in red, and this tells you that the trend is down, and then the market should be offered resistance on bounces up to these moving averages before making new lows for the trend. Okay, so let's go through a few examples here where we see the moving averages. I'm using 3 moving averages in these examples, although any combination can be used. And I'm picking 20-day, 50-day, and 100-day, or 20 bar, 50 bar, and 100 bar. Although, as I say, any combination can be used. If they work for you, they work for you. That's great. They all do the same kind of thing. So in this case, what we've got here is a chart of Eurodollar. It's a daily bar chart, and you've got the 20-day, the 50-day, and the 100-day moving average. So what you've got here is the price closing above all 3 averages here. The blue, the shortest one, above both of the longer term ones, giving you a bullish trend indication. The market trending higher, and when the market pulls back, it finds support on, in this case, at the shorter 20-day moving average before going up again. Sideways action. 20-day moving average more or less provides support on the dip, goes to new highs, and we see a big kind of swing higher here, pulls back, 20-day moving average rising, finds support, breaks up to new highs, and then it tops out, goes into a range, and then it tops out. So that's effectively the first example there. Second example here, this is the same averages, but this time again on Eurodollar, but on a 5-minute chart. So what we've got here is Eurodollar basically chopping around, and then we get the blue shorter moving average, the 20-bar moving average above the other 2, telling you that the trend is up. Market starts to trend higher, finds support on the dips at the 20-bar moving average, which is rising. It's above the rising 50-bar and above the rising 100-bar, typical bull market action. So you can see the pullbacks, they find support more or less at the rising 20-bar moving average until we get this big kind of blow-off situation here where the market gets really overextended and then starts to see a bit of two-way price action here. Okay, so trend traders and swing traders will use moving averages in slightly different ways. So if you're a trend trader, what you typically do is you wait for the signal, the trend signal, to get you into a trend, and you typically hold the position all the way through these pullbacks within the trend, and then you get out and reverse when the trend has given you a reversal signal. That's typically how most trend followers, trend traders work. They're not looking to get small pieces of the trend and then wait for the optimal point at which to get in. They typically go in on the reversal signal, and then they reverse their position the other way around when they get a reversal signal in the opposite direction. Whereas swing traders, they would like to be a bit more surgical with their approach. They like to identify the trend, but they want to get in after a pullback against the trend and get out after a nice big move in the trend's direction, and then wait for a pullback again to get into the trend again. So, as I say, trend traders typically like to be always in the market. They like to be participating in every trend. Many of the popular systems that you may have heard about, for example, the Donchian channels, which I'll talk about a bit later, and the moving average crossover systems, they rely on trend traders being in the market all the way through. So they never miss a trend move. But obviously, the market is not always trending. So there will be times when the market goes into chop phase, and the trend followers will typically give back some of the gains that they've made during the trend, and then they'll hopefully make their money back up again when a new trend goes again. So as soon as a new signal kicks off, the trend trader is in the market and they're looking for the move. They're ignoring all the pullbacks and they're just looking for that middle part of the move, which is usually the most profitable. Whereas a swing trader, as I say, they're not going to be in the market 100% of the time. They're looking for more optimal entry and exit points to profit from the movements of the market. And by so doing, they're freeing up some of their capital to be employed in other markets and perhaps to do other things. So the idea for a swing trader will be to use these moving averages or use the trend following indicators as a means of market timing to tell you when is a good time to get into this market according to the direction of the trend. Now, with swing traders, there is a risk of missing the move. The trend trader will always be in every single move because they're taking every single entry signal. They're reversing their positions more often than not. Whereas a swing trader will be waiting for the pullback. Now, if that pullback doesn't come or doesn't get to the point at which they optimally would like to get in, then they will miss the move which they're trying to get into. So that's, I think, one of the drawbacks about being a swing trader. Okay, so just a bit of some graphical representations here to show you how the trend trader and how the swing trader typically use these trend following indicators. So the trend trader, in this case, we're talking about where are we now? We're talking about the red line here being the short moving average crossing above the slower, longer term moving average. So the trend trader will get in on the red crossing above the blue. They'll hold the position all the way through the chop like this. And when the red crosses below the blue, they will reverse their position to short and they'll be looking for this move down before going long when the red crosses back above the blue. Whereas the swing trader, what they'll be doing is they'll be looking for the move in the direction of the trend, which drags the moving average up. And then they'll be looking for this pullback towards the moving average. In this case, here's the red shorter moving average, but it could be the longer moving average. It depends on what they're using. Waiting for the pullback towards the moving average before looking for a good entry point with a nice low risk stop loss, looking for the swing to new highs. Okay, so let's take a look at how a trend trader would use the moving average. So some examples here. So here's an example here. This is gold futures, and it's a weekly chart, again with the 20, the 50, and the 100 week simple moving average. So what we've got here is we've got a situation here in blue where the shorter one crosses above both the longer ones. The price is well above certainly the longer ones and then above the shorter one here. So this gives you the bullish indication. And we're buying these dips back towards the rising 20-week moving average. So as before, you can see how the 20-week moving average offers some pretty good support within an uptrend. So when these pullbacks come, the market doesn't stray too far below the moving average. It kind of bases out within this zone between the blue and the red. So a trend trader will be looking to get in on this point here, and they'll be ignoring all these pullbacks. This is for the swing trader, and they'll be holding all the way through, perhaps adding on breakouts as the turtle traders did, and making as much money as they can during this trend before they get the reversal signal, and that comes here when the blue is below the red and the pink. So the short is below the longer term moving averages, and the price is below all three, and then we get the trend going in the opposite direction. So the trend trader here has gone long in here, and they've gone short in here. They've captured a good swathe of this this uptrend. They've not got in at the absolute low or out at the absolute high, or got into the new short position at the absolute high. They've got in on the reversal signal. Okay, another example here. This is dollar yen. This is a 30-minute chart, just to show you this thing works on intraday charts as well as multi-day and multi-week charts. Here, dollar yen starts off around the price of 110. You can see the price is below the short and the two longer moving averages. Starts to trend lower. We can see the initial bounce finds resistance at the longest moving average actually here. They're a little bit close together, so the longest moving average appears to do most of the work. Market reverses and comes down, makes a new low, trends lower. Then we get the bounce. In this case, the 50 bar moving average is doing the resistance, chops, and then we get the bounce up to the longer term moving average, which caps here, breaks down to a new low, bounces back in. Again, the longer moving average pretty much keeps a lid on it, and then the market breaks down, and we see some aggressive gap down here, and the market starts to look very overextended. But from a trend trader's perspective, short in here, and you've held it all the way through these dips. Another example, this is Euro Yen on a 30-minute chart. You can see here the market breaks up quite aggressively here, pulls back, and then the averages are starting to go higher, and then we're starting to look to buy Euro Yen on dips. So we get the dip here into that between the blue and the red, breaks up again, pulls back, the 50 bar moving average more or less contains it, breaks up to the high, and then the market aggressively breaks down, and then we get the short signal. So the trend trader is essentially long for most of this move higher, gone short in here, and then captures this move and ignores all these counter trend bounces on the way down and is still holding short. Another example, this is Kiwi dollar daily. So market starts off going sideways, but we get the shorter average crosses below the longer term moving averages here. This gives you the bearish trend bias. Then the market eventually breaks down and then starts to see bounces into the blue and the red zone. So the 20 and the 50 are more or less capping the bounces, breaks down aggressively, and then we gets really overextended here. Then we start to see some very wide swings, and then we get the buy signal here. The market has basically crossed over from short to long. So the trend trader has captured most of this trend move. Okay, so let's see, that's all about the trend trader. Let's take a look at how the swing trader might use these moving averages to time the markets. So the swing trader, what they're doing is essentially they're using these moving averages to give them the directional bias. So they're saying, okay, I want to sell this market because the directional bias is down, but I want to wait for a more optimal point to get into this market. I don't want to get in as soon as I get the crossover, as the trend trader does. What I want to do is I want to wait for the market to, number one, define a downtrend for a short. Number two, correct back up into the sell zone, which could be anywhere between the 20 and the 50-day moving average, for example. And once it gets into that sell zone, then I'm looking for a bearish reversal pattern, for example, or maybe a reversal on the charts of a lower time frame, something that tells me that the momentum has turned back to the downside again and that the downtrend is resuming. So in this case, what we've got here is we've got dollar yen used with the 20-day moving average, 20, 50, and 100. So we're seeing the downtrend, then we're seeing the bounce back up, hits the falling 20-day moving average, that caps it, then we get the reversal lower, then we could be looking to sell into it with a stop over the high for the correction. We break down to new lows, we get an aggressive sell-off. This could be a good place at which to think about covering shorts after a big aggressive sell-off. Then you start to get a little chop. Then eventually the 20-day caps it there. Then we get a bearish reversal pattern on this day here. Maybe a good place to sell. Demand supply is kind of greater than demand on a 1-2 day basis. Break down to new lows like that. Another example. Now this is a weird one. This is the dollar against the Turkish lira on a monthly chart. Now this is using the a price envelope which I mentioned earlier on. This is a 12 bar simple moving average of the high and of the low. So it's basically, we're not looking at the average of the close, we're looking at the average of the high, and we're looking at the average of the low, and it creates a band which we can use. So what we've got here on dollar Turkey is we've got the price closing above the top of the band and then starting to trend higher. And then we get the corrective pullbacks that go into the band, into the neutral zone. And then we break back through the top of the band, which gives you a kind of a bullish signal that we're resuming the trend, and swing traders can get in, placing a stop under the corrective low. Pullback comes into the band. We're looking for a reversal pattern, and then a break perhaps through the top of the band. Good entry point for the swing trader looking to hold for a few bars. Pull back into the band, break above the top of the band or a reversal pattern. Market aggressively goes higher. Then we get the pullback into the band, the correction. See how the corrections come back into this band. And then once we're into the band, we're looking for a buy indication. And then we get in. I've kind of marked these potential buy points here with these up arrows here. So basically where these up arrows here are kind of where the market comes into the band. And we see, for example, the range is larger on the up bar than it is on the down bar, that kind of thing, maybe like a 1 bar reversal, a bullish engulfing pattern on a candlestick if you're using candles. Something to show you that over the short term, demand is greater than supply or is overcoming supply after a correction into the neutral zone. In this case, we get a very aggressive move higher, a bit of a blow-off situation here where we see this really aggressive move, and then the market starts to go into chop mode. But again, we're finding support within the band. Okay, another example here. This is the dollar against the Chinese currency. Initially, we get this big breakout to the upside, and then we start to see this. We're waiting as a swing trader. We're waiting for the pullback into the into buy zones. So in this case, we come back to the 20 week moving average. It's a weekly chart, and we're looking for a buy situation here. We get a nice reversal here, little double bottom on the chart, and away you go. We're waiting for a buy. We come back into the buy zone here, hit the blue line, bounces up, not a very good one there, comes back again, and then we start to see this basing action, and then we can get in with a stop under the corrective low, looking for new highs. The market goes up to its high, chops around, we get a kind of a top pattern, and then the market breaks down aggressively, and we get a situation here where the market really is trending down and is below the moving averages, waiting for a pullback to the falling 20-day, which we get, and then we're looking here for a bearish reversal pattern, which we get, and that can give us a good entry into the downtrend, which we see some nice aggressive movement there. Okay, Eurodollar, this is an hourly chart. So in this case, what we're doing again, we're using the same moving averages. It turns out the 50 bar moving average worked quite well in this case for the hourly chart. So Eurodollar is trending lower. We get the bounces back up to the falling red 50-hour moving average, pretty much caps. And then we get a reversal pattern here looking to enter for a short trade, breaks down aggressively, bounces back, doesn't quite get to the 50. It just breaks into the zones, it breaks down again. We get another pullback here, hits the falling 50, get a reversal pattern here, then eventually we break down to new lows. Market goes into chop mode on these few days here, and then we get this big thrust higher, which turns all the averages higher. Now we're starting to look for buy from a swing trading perspective. We're waiting for the pullback, and the pullback comes into the, in this case, again, the now rising 50-hour moving average. That offers support here for the swing trader, push to new highs, pulls back 50 bar moving average, push to new highs, comes back down 50 bar moving average, bases out, makes new highs, aggressively goes higher, and then we get this big pullback against the trend, but again, find support at the rising 50 bar moving average. So a number of opportunities there for the swing trader to get into the trend using the moving average. Okay, dollar yen hourly, another hourly chart. So dollar yen starts off by trending lower. You can see the bearish configuration of the moving averages. We've got the The blue and the red both below the pink. The price for the most part below the longer pink moving average. And we can see the bounces again being capped around the falling 50 bar moving average. So a swing trader is waiting for the first of all determining the trend is down, waiting for the pullback up to the moving average, waiting for a reversal pattern, a bearish reversal pattern, then entering with a tight stop over the corrective high, looking for new lows. So market goes into chop mode here. Market hits the falling 50 bar moving average. We get a reversal pattern here on the bars or the candlesticks. Good place to take a stab at the short side. Market breaks down to a new low, bounces back up, hits the falling 50 bar moving average. Nice little reversal there. Short indication, market breaks down, and that's the way the market is going. Okay, so this is just a little graphical representation of how one can use the price channel, or the bands rather. So what we've got here is an uptrend. So the market is breaking highs, it's trending higher, it's going higher highs and higher lows, the black line. The way to use the bands could be to obviously define the trend as in the market is above the moving average and the band is sloping to the upside. And in this case, I'm using moving average with moving average plus 1%, minus 1% bands around the moving average. So you're waiting for the market to start to move higher and get a pullback towards the moving average and looking to take profits at the top of the band. So the market pulls back to the red line, the moving average, turns higher, breaks higher, hits the top of the band, take the profit, back down to the moving average, basis out, and then back up to the top and take profit there. So that's one way that traders can use the moving average bands. Okay, I wanted to say a few things about filtering techniques, because obviously the shorter term moving average that you use, or if you use, for example, price versus moving average, there are going to be more whipsaws than not. So one way to do it, obviously I mentioned two closes. So this is how that kind of looks. So in this situation here, you've got the market's moving higher. It's above the moving average. It's trending higher. Then you get this is one close below the moving average. And then the next bar, it closes back above the average. So that could have been a whipsaw had you sold into that if the market continued higher. But you're waiting for two consecutive closes below. So one close below, one close above. Now we get a close below. Next bar, we get another close below. So that's your filtering technique. You've filtered out the whipsaw there. So that's essentially how to use two consecutive closes below the moving average for confirmation. And also the idea about using the channel as a neutral zone. In this case, market's above the channel. You're buying dips towards the top of the channel. But if the market closes within the channel, maybe two closes within the channel using the whipsaw method, then we're in a neutral zone. We don't have a directional bias. And then we're then waiting for the market to make a close or two closes outside the channel to give us our directional bias. Okay, so just to talk a bit more about the envelope. So we're talking about parallel lines drawn a set distance above or below a moving average. So using a 1% envelope on a 20-day simple moving average is one common way to do it. And they can provide some really good areas of support or resistance when we have an established trend. So with regards to overbought, oversold areas, now this is a subject I'm going to be covering on the next webinar when we talk about oscillators and whether the market is overextended. The way to do this would be to use visual inspection in many cases. So next thing to do is to think about what could be the strategies to use in an uptrend. So if you are a with trend trader, we're looking to buy into the market. So what we're trying to do with the envelope is to buy on a pullback towards the moving average, and then to take profits towards the top of the envelope in an uptrend. So if you're in a downtrend, we're waiting to sell at the moving average or near the moving average, and to take profits around the envelope, the lower envelope within the whole pattern. If you want to go counter trend, that's one thing that you could do. That's another thing to think about if you are a counter trend trader. Some people like to play mean reversion trades, and that's fine. One way to use moving averages to do this, or envelopes to do this, would be to look for a reversal pattern around the top of the envelope or the bottom of the envelope, and then look to take profits on the pullback towards the moving average. Okay. So now I'm going to talk a little bit about Bollinger Bands. So Bollinger Bands are basically, they use the envelope concept, but they're based not on a fixed distance above or below the moving average in terms of percentage, but they use volatility. So they use standard deviations. So in other words, the typical Bollinger Band setting is 2 standard deviations above or below a simple moving average. So the idea is that when the markets get volatile, if the market suddenly ramps up to 2 standard deviations above a moving average, it's said to be overextended and is due for a pullback. When markets get quite volatile, in other words, the ranges of the market start to increase, then the bands, the Bollinger Bands, start to widen because the standard deviation, the volatility measure, actually puts a larger number into the equation. So what you do is what happens when volatility starts to rise, as determined by the daily ranges, we will start to see a widening of those bands. So it will take a bigger move before the market gets to its overbought level or its oversold level. Another thing to mention about volatility with Bollinger Bands is often before a big movement in price, in other words, a big explosion in volatility, the market tends to be in a kind of a low volatility squeeze situation. So the bands, they get narrower and narrower as there is less and less interest in the market, and the market just gets, just gets basically inactive. No one's interested. The daily ranges get smaller, volatility contracts, and the bands contract, and that typically precludes a very large movement. Once you get a breakout after a nice squeeze in volatility bands, in Bollinger Bands, then those movements can typically be very explosive and worth jumping on. In fact, people who don't necessarily follow or are trying to capture trend moves, some people use options, for example, to play volatility. So when volatility contracts, as characterized by very narrow Bollinger Bands, they may buy call and put options looking for an expansion at the money, call and put options looking for a large expansion in volatility. So the breakout of a Bollinger Band, whether it's up or down, is actually a major event because approximately 90% of price action is usually contained within the bands. So once we break above or below a set of Bollinger Bands, then we need to monitor the price action because it could either warn you of a new dynamic, a trend starting to unfold, or perhaps the market has gone too far too fast and we should be looking for mean reversion type trade. So with regards to the overbought, oversold levels, as I mentioned before, with these things, it's good to use obviously visual inspection to determine how many standard deviations one should use. 2 standard deviations is the default setting, but the default setting isn't always the best setting. So as with all of these indicators, I would advise spending a bit of time studying the market that you do. I'm sure every market has its own characteristic. Studying the market that you're looking at and figuring out what is a good level of moving average to use, what is a good level of standard deviation to use. Okay, so now we're going to take a look at a few examples of Bollinger Bands and a few potential buy and sell ideas. So in this case, we've got the 20-day Bollinger Band on dollar Canada. We can see that the market has been in a bit of an uptrend over this period. And what we've got here, the pink line is the 20-day simple moving average, and the Bollinger Bands are the 2% or the 2 standard deviation rather above and below it. So what we've got here is the price finding support close to the rising 20-day moving average, rallying topping out around the top of the Bollinger Band before it comes back down, back to the moving average, looking to buy, looking for a move to the top of the band or new highs. Market pulls back, finds support around the moving average, breaks up, crawls along the top of the Bollinger Bands. Good place to take some profits for the short-term trader, maybe even to go counter trend, as I said before, if you're a swing trader. Pulls back to the moving average, base is out, good place to buy. Back up through the top of the Bollinger Band, tops out, comes back, nearly finds support there, doesn't quite make it, breaks again. Next pullback it does, it breaks through the rising 20-day moving average, nice reversal there, breaks up, good indication to get you in for new highs, breaks up through the top of the band, good place to take some profits or maybe go counter trend, back down to the moving average, and then back up to the top of the band. This one actually not great for a counter trend trader because it just continued to go higher, but eventually the bubble burst and dollar Canada came down quite aggressively. So a lot of opportunities there for the trend, or for the swing trader rather, playing the trend and anti-trend as well. Okay, another example here. This is Eurodollar. This is so an hourly chart. Starts off trending higher, finds support at the slightly rising pink moving average, the 20-bar simple moving average, breaks up, hits the Bollinger Band, little profit there, tops out, breaks down, and then we start to trend lower. Market bounces back up to the moving average, good place to get in, looking for a push to new lows, and then the market goes into a bit of a chop. The bounce is finding resistance at the falling pink moving average, and good places to take profits at the Bollinger Band here. Market bounces back up, tops out just above the moving average, back down to the Bollinger Band, good place to take profits, or maybe even to go counter trend. Okay, now this is to show you the example of the squeeze phenomenon I mentioned a little bit earlier with these Bollinger Bands. So another way to use Bollinger Bands is to play volatility, is to wait for the bands to squeeze, in other words, to get to a very narrow kind of bottleneck, and then wait for a breakout on the chart or above the top of the Bollinger Band to give you an indication as to a very large explosion in volatility. So what we had here, this is silver futures. What we had here was the market trending higher. Then it went into a large or a long kind of price band here. And you can see how the Bollinger Bands got to very, very narrow levels here, unprecedentedly narrow levels here. And then when we got the break to the upside, that gave you the indication that the volatility was being resolved to the upside. And then we got this massive explosion in volatility and upside volatility as well, because we're breaking through the top of the Bollinger Band. So that could have been used from an options perspective, perhaps, or just a directional bias with volatility here. Okay, another thing to mention, perhaps a little bit more arcane, but while we're on the subject of price channels and moving averages, I'm just going to talk about Keltner channels, because sometimes some people like to look at Keltner channels. Now, these are similar to Bollinger Bands, but instead of using the simple moving average, they use an exponential moving average, and also they use the average true range as the volatility measure. So average true range is basically, it looks at the average, if it's a daily chart, it looks at the average daily range after the last n bars. So the 20-day average range would be just looking at the daily range over the last 20 bars and calculating the average. So as the daily ranges expand, volatility increases and the average true range rises. So as the ATR rises, the channels, a bit like the Bollinger Bands, the channels widen, producing higher or further away overbought and oversold levels. The typical overbought and oversold extremes are the exponential moving average plus or minus 2 times ATR. So in some respects, kind of similar to the Bollinger Band, but a different kind of calculation. Again, as with Bollinger Bands, I think visual inspection is quite a good way to figure out, according to your market and your time frame, what is the best level of Bollinger Band to figure out whether we're overbought, oversold. and also whether we are using a good indicator to get you into a trend situation. Okay, so now on to Donchian channels. Now, Donchian channels are one of the oldest and simplest methodologies which trend followers like to use. I'm sure, no doubt, you will have heard of the Richard Donchian himself. He's known as the father of modern commodities trading methods, and he developed these simple methods back in the 1950s with a view to capturing movements in particularly in the stock market indices and individual stocks. So the basic principle is to buy when the market breaks out to a new N-bar high, and to sell short when the market breaks down to a new N-bar low. Now, the traditional methodology here is known as the weekly rule, and it's to buy or sell a breakout to a new 4-week high or 4-week low. And this formed the basis of the famous Turtles trading system, which was traded, I think, back in the 1980s. So when you plot a price channel on a chart, you're usually given two lines: the highest high for the last N bars, and the highest high for the last N bars, and the lowest low for the last N bars. But very often you'll get three lines, a third line, which is just simply the midpoint of the price channel. So the highest high for the last 20 bars, the lowest low for the last 20 bars, and the midpoint of the last 20 days for a 20-day price channel. So we're looking to identify the trend with a close above the top of the channel, and to identify a downtrend for a close below the bottom of the channel. And as with the moving average strategies or systems, you can be, they're typically used as an always in the market system. So you're either long or you're short as the market breaks above or below the top or the bottom of the channel. But as with most moving averages or trend following indicators or systems, they have a low win probability because trends tend to occur, I'd say, less than 40% of the time. But as with moving averages, the idea is to capture as much of a trend, perhaps in the middle part of the trend, as one can possibly do. You're not looking to catch the turning points. Okay, so I just want to show you a few examples of Donchian channels. This is Eurodollar with the 30-day 30-bar channel. And what we've got here is initially the market closes above the top of the channel, confirming an uptrend. And then we start to see the market find support at the middle of the channel here. So it works in a kind of way to the moving average, except that it denotes the middle of the channel and not the N-bar average of the closing price. So in an uptrend, you're looking for the middle of the channel to find support, and you're looking for the market to maybe break through the top of the channel and continue its trend, or maybe take some profits at the top of the channel. So here the market pulls back, finds support around the middle of the channel, breaks up, pulls back, finds support at the middle of the channel, breaks up again, and then it can't get back through the swing high, and then it tops out. Then the market breaks through the bottom of the channel and confirms a downtrend all the way down. Market gets a decent bounce, finds resistance at the middle of the channel, breaks down again. More or less the middle of the channel is forming a bit of a cap. Then eventually the market breaks down. Okay, another example. This is gold futures on an hourly chart. The market breaks up, confirming a new uptrend. Market pulls back to the middle of the channel, finds support, breaks up again. Pulls back, finds support at the middle of the channel, breaks up again, finds support just below the middle of the channel, doesn't break down to the bottom of the channel, comes back up again, aggressively moves higher. Pull back, middle of the channel, bases out, new highs. Minor pullback here, finds support middle of the channel, breaks up again aggressively, pulls back, middle of the channel is finding support on these dips, more or less, then the market breaks up again. Australian dollar, 5-minute chart, market breaks down through the bottom of the channel, closes below it, confirming a downtrend using the channel, market bounces, middle of the channel caps, more or less, breaks down, bounces, middle of the channel caps, breaks down, bounces, middle of the channel caps, new low, sideways, middle of the channel caps, down, middle of the channel caps again and again, and then aggressively moves down. Then when we get the kind of penultimate pullback, or the last pullback before the swing low, finds resistance at the falling middle of the channel. Dollar yen weekly chart, market closing up the top of the channel, trend is up, wait for the pullback, middle of the channel, good place to buy, new highs. Pulls back, finds a lot of support around the middle of the channel, dips below it, doesn't make a bearish signal here, breaks up again, new highs, pulls back, middle of the channel finds support, breaks up again. So the middle of the channel seems to be, once you've defined a trend, if you're a swing trader, it can be a good place to look for counter trend pullbacks to terminate before you take a stab at the trend. Okay. So now I'm going to switch across to the MetaTrader platform, and we're going to take a look at a few examples of where we are with some of the major markets, and just to see where we are in terms of trend. Okay, so just to kick the thing off with Eurodollar. So what we've got here, I've got the same moving averages here. Just 1 second. So yeah, let's just view data window that. Yeah, there we go. So we've got the 20-week moving average, the 50-week moving average, and the 100-week moving average. So what we've got here is Eurodollar. What we've seen over the last couple of years or so, a bit of a downtrend, but a very choppy downtrend at that. For the most part, Eurodollar has been finding resistance at the falling moving averages. The last aggressive one there, it briefly broke above the falling 100-day moving average, broke down to the new low, and now we've come back across all of the moving averages. It looks like we're trying to close above the slowest moving average, which is usually quite a good a bullish indication. So watch out for a close above this moving average, a weekly close, few days to go, and that will put a lot of pressure on this swing high. And I think once we can get through this swing high, this is a very important level, 114.94.5. Once we can get through there, then I think we are off to the races on Eurodollar. I'll talk a little bit about longer term views once I've just had a quick run through of these markets. So what we've got is a downtrend. We've been in a downtrend, but a very choppy downtrend, and we're settling above the moving averages, which is an early indication that this trend may well be turning. We've not got the short crossing the longer moving averages yet. That's taking time, and that may give you a very late signal. We'll have to see where we go with that one. Okay, let's take a look at dollar yen. So dollar yen, it's been in a sideways market for a very long time. It's really not been not really been following a major trend at all. Just a lot of big moves up and down, stuck in a range. Recently, what we're doing is we're actually the moving averages haven't really helped us a whole lot because we've been in a range market. If you recall, I mentioned that when markets are in ranges, the moving averages don't really help you so much. But what we're doing at the moment now is we're as with Eurodollar, we're starting to settle on weekly closing basis below moving averages. So we're starting to get a little bit of an indication that perhaps we want to at least have a crack at the downside in a weak dollar situation. Sterling dollar cable. So what we've had there is we've had a bit of a downtrend, a very aggressive move to the downside, and then a very large reversal to the upside. So it seems that we broke down through this key level here, which corresponds to the low back in 2016. We're starting to sort of trend higher. With regards to moving averages and trend indicators, not a whole lot of real indication there. The falling 100 moving average has capped it for now, but I don't think I'd be massively confident using moving averages with this one at the moment. I think sterling is taking a little bit of a back seat, but again, watch out for closes back above this falling moving average, and that could give us the indication that perhaps we're going to be testing the top of this range in line with a weaker dollar against the other markets, but I think sterling is going to underperform. A bit more interesting, I would say, would be Aussie and Kiwi. So what we've got here on the Australian dollar is we've got a market here which obviously has been trending lower. You can see the falling 20 and 50 have been pretty much capping the bounces on the way down. Then we've got this really aggressive move to the downside, followed by this big reversal higher. And this really has put a floor under the market, the aggression of this move. And as with Eurodollar, we've cleared the shorter moving averages, and we're now threatening to close above the falling longer moving average, the 100-week moving average. And I think that is going to be giving us a bit of a bullish indication that we could be heading a lot higher with the Australian dollar. So certainly this big move down has flushed out a lot of shorts, trapped a lot of short sellers. Kiwi is showing you a very similar situation. So Kiwi, a little bit of a downtrend. You can see a little bit of intermingling there with the averages, but more or less the three averages are forming a bit of a cap to the market. But now we've got a situation where we've cleared the shorter averages, we're settling above them, and now we're challenging that falling 100 bar moving average. So should we settle above it, then look for a big move up to some of these highs and perhaps a new uptrend for Kiwi dollar. Just want to move across to gold, which has performed really, really well. You can see with gold, again, using the weeklies, we've got a kind of a bullish crossover here where the shortest one is above all of them. Price is above all of them. And then we're getting the pullback. The rising 50-week moving average finds support there. Up it goes, pulls back. Rising 20-week pretty much makes support, new high, pullback, finds support on the rising 50-week moving average, back up to new highs. The previous dip didn't quite get back to the rising 20-week. But gold looks to me to be pretty constructive, and I think we're going to be heading up towards the highs that we saw several years back. Okay, so that's a little run through of the charts. I just wanted to show a few examples on TradeStation. Just 1 second. Okay, so let's do another screen share. Okay. One thing I wanted to mention previously on the Donshin channels, I use the 30-week Donshin channel as a good long-term indicator for the dollar against its major European counterpart. So it's quite a good, it has been over many, many years, a very good trend indicator for the US dollar against its major European counterpart. First thing I want to show you is, this is quite an arcane one again. This is the dollar. This is actually the Deutschmark future prior to the birth of the euro in 1999. So before the birth of the euro, what we had was the dollar trading against the German mark, and we could track it by looking at the Deutschmark futures contract. So this is basically the blue channel that you can see is the 30-week Donshin channel. So it's the highest high for the last 30 weeks, and it's the lowest low for the last 30 weeks. So what you can do, I've omitted the midpoint for this particular purpose. So what you can see going back a long, long time, this is like the 1970s, the 1980s, 1990s, is you can see the Donshin channel. It gives you a very good indication as to the major trend for the dollar against the German mark in this case. Now, in addition to the Donshin channel, I've included what I like to call the swing high, swing low indicator, and it's simply the highest high for several bars before it and several bars after it. So in this case, it's a swing high, swing low bar with strength of 6. So in this case, this high, the swing high here, is higher than the previous 6 weekly highs, and it's higher than the following 6 weekly highs. So when the market breaks above a swing high of strength 6.6, or it breaks below a swing low of strength 6.6, that often gives you a very good trend indication signal, as does the 30-week Donshin channel. So just to show you, if you were to use this as a system or an algo going back, this is the Deutschmark future going back from 1976 to 2001. So what you've got here is The number of trades that you get, you have 19 trades, 10 are profitable, 9 are not profitable. The profit factor here, you can see, is a very respectable, nearly 8 times. And you can see a very good upward equity curve to show you that the strategy is quite a good one. Percentage profitable, 73%. So that's the German mark. So now you flip it across to the dollar index to show you exactly the same indicator, but over a different period. So the dollar index starts in the mid-1980s, and that goes up to the present day. So you can see all of the buy and the sell signals. The dollar index, this is the equity curve doing exactly the same thing that we did on the Deutschmark index. You can see the equity curve is a nice upward equity curve, which is what you want to see. It shows you that as a trend following indicator, the combination of the 30-week Donchian channel and the 6-week swing high, swing low indicator is not a bad trend following indicator. In terms of profitability and hit ratio, over the period, we're talking a long period now, from 1985 to 2020, we're talking about 61% profitable and a profit factor of 3.4 times, so also quite respectable. And finally, where does it leave us on Eurodollar? This is Eurodollar with exactly the same indicator here. So again, the 30-week 30-week channel high, 30-week channel low. In fact, you can see, I mentioned before about whipsaws, you can see recently, because we've seen this big kind of volatile situation in ranges, we've seen a few whipsaws for this particular indicator, and obviously that results in a little bit of losing money over the short term. But that's just the nature of trend following indicators. So let's have a look at the Eurodollar, how it's performed on that one. So Eurodollar, we're talking about 1998 to 2020, 22 trades, 11 winners, 11 losers. So, let's see, so 15 winners and 6 losers, 68% profitable. So it's been it has quite a good hit ratio on Eurodollar. Profit factors are a nice healthy 6.38, and the equity curve on Eurodollar here, you can see it basically follows the same format as we saw on the Deutschmark futures and on the dollar index futures. So I just wanted to show you those few charts. So in terms of trigger levels for a major move on Eurodollar, this level I mentioned before when we were looking at the channel highs and lows before, it's that 114.95. So we're not a million miles away from it right now. Once we get above 114.95, then we have a buy signal on this particular strategy or indicator. And okay, recently we've seen some whipsaws, but the kind of move that I'm talking about we could be capturing or looking at once we break above 114.95 can be something very similar to this move here, which I recall discussing and calling at the time. So basically, we're looking at a multi-month massive move to the upside on Eurodollar, a downside move on dollar index. The trigger level on dollar index, equivalent to Eurodollar, is 94.5 on this dollar index futures level. So basically, once we break through the year's low on the dollar index, and I think the action that we're starting to see on dollar yen, which basically ignored everything up until recently, this shows that we're seeing some broad-based dollar selling, which could finally tip this thing over the edge. On a parting note, what I wanted to show was also, and this is something that we'll be covering a little bit further down the line in the Elliott wave Fibonacci section, is just to show my Elliott wave call on the dollar index, which actually is quite bearish. So for those of you that follow or use Elliott wave, you'll know that the market breaks down into structures of impulsive waves and corrective waves. The corrective waves obviously go against the trend. The impulsive waves go in the direction of the trend. The trend moves break down into 5-wave sequences, and the corrective moves break down into 3-wave sequences. So what I've got on dollar index here is back to the 1980s, the Plaza Accord, when the dollar was basically capped after it got too strong. We saw a very large thrust down, which formed the momentum low. Then we saw a nice, very strong corrective rally higher, and that kind of unwound the oversold condition at that time. That's wave A. Then we got a choppy decline in wave B. This is an Elliott wave, irregular flat correction of the first move down. The C leg took you up to this point here, top down, and then we started to see another 5-wave decline, which we saw here. So since this point back in 2004, we've seen a very similar correction to the last one. So we saw an A-leg rally here, which was very similar to this one, and a choppy decline to new lows, where we see the typical momentum divergences. Again, momentum is something I'll be talking about in next week's webinar. So we saw the momentum divergence here in the low, and then the rally from 2011 is basically just the C leg of the correction within the bear market. So recent price action on the dollar, we've seen a big reversal here, a lot of bearish divergence on the indicators, on the momentum oscillators, a nice trap, failure above the previous high, and it looks to me like we're about to enter a big decline in the value of the dollar. Okay, so I think we should wrap it up for the time being there. If anybody's got any questions, I'll be very happy to field some questions. Let me just flip across to the main screen. Okay, so if anybody's got any questions, please feel free to fire them across. If there are no questions that you can think about right now, I'd be very happy to address them if you wanted to fire me an email. My email is hmfsystems@gmail.com. So please feel free to, if you haven't got any questions that I can answer right now, I'll be very happy to field them at a later day and time. Okay. Okay, so if there are no questions, I'd like to wrap it up there. I hope I've covered a lot of good information there that can help you in your trading with CFI on the trend following and the swing trading methodologies. I look forward to seeing you at next week's webinar, where I'll be talking about oscillators and how you can define whether a market is overbought, oversold, and to look to get into the market to play oversold, overbought extremes. So thank you very much, and I look forward to seeing you next time around. Thank you.